Hey everyone, today we will talk about why do we choose 17 delta, not over 17 because sometimes the strikes are not available, but between 17 and 20, that's our go-to space for any short premium trade. And why do we select that? Why has that been a good proxy for us, a good mechanism for us to do these trades, manage it better and whatnot. So on that note, I'm going to share my screen to show you how and why we trade 17 delta. I'm in my paper trading account. For my teaching purposes, I use this account more because it's easier for me to put the trades on, take them off just to show the examples and everything. It's basically the same as your live account, but the fee structures are different. So whenever I spot a difference, I tell my audience, this is what I'm seeing. In your live account, there'll be higher commissions, which is what we normally see in our futures options space. And I'll show you exactly what I mean by that. But anyway, let's get into the platform right now. Quick look at the markets. The markets are up today. E-mini S&P 500 futures are up 23 points. Gold is down a little bit, but again, through the roof so far in the last 1 year. The Euro currency is down, and then the Nasdaq is up quite a bit, so over 117 basis points, which is good. I have some tech stocks here and there, so that's always good. Let's pick a underlying asset and then just go through the whole 17 delta option trade. I would encourage you to go back and look at the 30 and the 45-day video that we made. It may help you to grasp the knowledge to apply here, because this is the second step. So first we decide on the days to expiration, which is always more than 35, 40, 45 days out. That's how we look at things. If I was going to trade anything today, let's look at some oil action. Now, oil action, I've been hearing that there's been a lot of inventories here and there. There's a lot of supply in the market, so the price should be going down from here. Volatility has picked up a little bit recently. It was up here, so we should have sold something, but we could not do it due to time constraints. The market is down today. It's been hovering around this level between 65 and 55, I would say. So that's the level. Let me just get a marker out. So this level is what oil has been trading at, 65, 55 level. I'm going to show you a strangle option trade today because there is no long option attached to it, so it's easier to grasp the 17 delta mindset. Usually our 70% of the portfolio is defined risk. So we sell credit spreads. When I say defined risk, let's say you have some stock position, we sell some cover calls on it. We have some cash in the account, we sell some puts on it to buy the stock. That's what I call the defined risk, which is what it is. Undefined is a strangle and a straddle. We don't really trade straddles. Not a big fan of it because I don't like to be very close to the market. Even though you get more premium, I just don't like the setup of it. So cutting it all short here, let's get a wide strangle trade in oil futures options. And the reason I say futures options is because it's cheaper to do it. You get same amount of exposure, but you put down half the amount of money to do this trade for the same amount of return that you're getting, or even sometimes third the amount of money that you would pay in an equity or a ETF space. There are other ways to trade oil as well. You can go and check the oil ETF, which is USO. That's another one. This is United States oil ETF. You can trade that. It is tied to the oil market. I think it tracks the futures market more than the spot market. And these are the only two ways. And then you can trade this /CL product directly, the outright futures. We don't do that. It's too heavy for us, too big of a commitment on the margin. So we don't do that. We trade the options on it. Anyway, /CL, this is the market I like. First thing, you're looking at the DTE. Again, we don't have enough. We don't have enough days here, 33, but in order to get trade done, would we take a 61-day expiration cycle? Not often, but because it's just too much time to be in the trade and not much happening during that time, the P&L is not coming. So we don't really like 60. 45 to 50 is our max, basically. So this trade should have been done maybe a week ago when the volatility was high, but I just could not get time to do the video. So anyway, volatility has come down a little bit, but we'll still do an example trade, okay? Let's take a 33-day cycle, and I'll show you exactly how we select. We're down on the DTE, right? We selected this. Again, like I said, usually this number is 45 for us. So just remember that. Anything less than 30, we don't touch. Anything less than 33, 35, we usually don't touch. Open this expiration cycle. Next thing. So step number 2 is you have to look at the volume and open interest. Okay. This is the key to getting into the trade, because we make sure that when we get into the trade, we are checking the box. We are going through our checklist and making sure that we are not picking up a illiquid underlying asset, which we don't normally do. We only trade liquid assets. So our tradable universe is probably 40 to 50 names, including ETFs and stocks and futures options. I shouldn't say futures. We don't trade futures outright, but futures options, yes, all that kind of stuff. So you can say we we have like 40 to 50 names altogether, which is our universe. We don't go out beyond that. That covers most of the market. That includes indices, ETFs, spot, and we are happy with that. We don't want to venture too much out of this space because then you get into illiquid stocks. There's not much volume in there, not for open interest. When I say open interest, this has got to be in thousands. This has got to be in thousands, sometimes not, because these small amounts you see, these are half strikes. So we don't trade these half strikes. We always trade the full strikes where the volume is, where the open interest is. Okay, so be mindful of that. If I were to suggest something, I would suggest not to trade these half strikes. Okay, there's not much volume. There's not much open interest in any. There is some open interest, but again, there's no volume. Open interest picks up during the cycle, but again, it'll be hard to get in and out of these half strikes. So anyway, trading a strangle. How do we click the button? Where do we click the button? What do we actually do? This is exactly what we do in our trade. 16 delta. I like it. It is at a full strike, a full number. 54. Okay, great. That covers the expected move for us. Okay, the expected move, I can show you if I can get the probability of cones going. This is another thing we look at. There's a study called probability of expiring cones. Okay, bring that in on your main chart and it will show you something like this. Okay, so from here, what this is saying is from here on where the market is, it's at 60. Let's call it 60, right? 58, 58.90, which is 59. It is expected to move this much in the next however many days. Now you're going from January to like June, so summertime. Okay, this is how the market is expected to move. We are taking this trade in the first expiration cycle in the next 30 days. So it's expected to move between somewhere, I would say here. Okay, so about 55-ish to like 65-ish from where it is right now, which means we're getting 5 points out from where we are at the money. We are going 5 points out. That's still not enough. When the volatility is high in this ticker, we normally get 7 to 8 points out, but that's not the case right now. So we will do a strangle trade, okay, to get more premium on both sides. Strangle is basically selling both sides. So again, I got the 17 delta strike at 54. I want to right click and sell a strangle. Why did I buy? I should be selling. Okay, sell a strangle. Now, selling a strangle, you will see the margin is high, which is fine. It's a naked trade on both sides. So calls and puts, you don't have any protection anywhere. 54 is our short strike on the put side. And on the call side, I'm going to go further out because you see there's so much call skew here. We were able to get from 59, we went down to 54. So only 5 points out on the put side. Same delta. From 59, we are going up to 68 on the call side. So that's almost $10 we're getting on the call side, which means there's call skew, which means there's a buyer element here. Meaning when markets panic, people go into oil, when there's plenty of stuff going on, macro driven stuff, it's on market, people go out and buy these assets. So the risk is on the upside. That's what it's showing. It's a call skew driven asset. Okay. So we will select 68 on the call side. That's a lot of coverage on the call side, but again, it hasn't touched 68 in so many days. Look at this. When was the last time it touched 68? Back here. So it was this time, April time last year, when the markets were in panic mode. It dropped from there. By the way, I should mention this. If you like these kind of videos and you want to go in depth to learn the strategies that we do and teach, there's a 5-day challenge that we run almost every month. First one is happening on Monday, January 19th. Spots are still available. I'll put the link in the description. It's in 3 days. Take a look at this. If this works for you, buy a ticket. We go through all these things, defined risk, undefined risk, the whole enchilada basically. There's a whole agenda here. I encourage you to invite you to take a look at this and see if this works for you. There are plenty of other free stuff on the website. There's a webinar that we do almost every week or every 2 weeks. We just finished one on Monday, January 12th. It was a good turnout. If you go on the main page and go down to our free stuff and what we're offering here, skill trading tools, go into this free stuff, you'll see these two. So there's a PDF where I cover 12 different strategies in detail. It's over 100 pages. It's almost up like 170 pages. A little bit too long, but take your time, read it. And there's a 5-day email course, which you will love as well. So these are the free stuff on our website right now. Take a look at it. Hopefully you will get something out of it. Okay, let's take a trade. So where are we? Trade, right click, I'm going this. Now, the next part is to analyze the trade. And when I say strangles are the easiest to manage. Just remember that. They're easiest to manage because they don't have any long protection on any side. Yes, they are a big product because they are naked on both sides. So you're a little bit scared of it naturally because there's so much money going down in this trade. Okay, so this is a good number. Like I said, this is a good trade. It's easy to manage. We love strangles, but we don't trade it much. But yeah, we're not scared of it. 65 is a good number here. Usually we like to see 68 or 70, but on a strangle, which is fine. We are not enough covered on the put side. We cannot go further back because then we don't get enough credit. And on the call side, we're covered because it gave us a good amount of expected move, which we took. So expected move is this gray chart. On the put side, it's going to go down to 51. On the call side, it's about 67, and we are choosing 68. Okay, so that's the difference. 126 means you're collecting $1,260 on this trade. Every tick is like $10. So 126, if you collect 127, you'll collect $1,270. It's a simple product. Each tick is $10. So all you need to know about oil. Don't be scared of these futures products. These are the easiest to manage. Once you get your head around it, they're only 10 to 12 that you can trade anyway. And once you know the exact tick sizes of it, it's the easiest product to trade. A lot of people are, not so comfortable with this, but it's our job to make it comfortable for people and teach them and show them the best investment for their capital. I like futures options because your leverage is 3 to 1, meaning you can do 2 of these trades for 1 that you do in the equity space. Anyway, same exposure, same everything, same max loss, same all that. Okay, 1260. That's a good trade. Now right click and confirm and send. Let's see. Oh, I should show you the Greeks as well, quick. Okay, let's look at the Greeks. A little bit short delta here because, we've gone further out on the call side, or we're selling juicier calls because there's more premium on the call side. So you're slightly short on the delta here. I'm not collecting enough positive delta on the put side because the juice is not there. Like I said, it's a call skew driven market. So you get juicier premiums on the call side. Okay. And that's the reason why you are short delta a little bit. Short gamma, totally fine. Theta is a good number here. We like this data. This is what we are looking to collect each day. Short Vega, trying to short the volatility here. These are pretty much the trades Greeks that we look at. Now look at the, okay, we're putting down $1,600 to collect $1,260. That's a good trade. Now, again, I should mention that this 450 is not the real number. If you do this in your real account, the live account, this will go up to like $7 or something. It's $350 for each leg. So you're putting 2 legs out, right? Calls and puts. So that's like $750 to get in, $750 to get out. We round it to $15 per trade, basically, without any management. If you have to manage this trade, then again, each management it will charge you, $450 or $350 based on whatever the commission sizes are. Okay, 1670. Now here's the trick, right? Let's say we collect 600 and we put down 1670. Okay, 35%. Still 35% return on this trade. But here's something you should know. This 1670 is not going to be static. And the reason it's up, it's a slightly more right now is because we are not in a 45-day cycle. If you choose a 45-day cycle, you can check that. If I do the same trade in a 61-day cycle, this will be different. This number is going to be different. Okay, I can quickly show you that by setting it up in a 61-day cycle too, and we can compare both. And that's the reason why we chose, where's the rest of it? Okay, because it's not giving me everything. Just want to quickly show you for the 61-day cycle if I choose the same. But again, look, if you choose 61, you still have enough open interest, enough volume. So we're not against that. You get 52, sell a strangle. And then on the call side, I'm going to select 17 is giving me 71. So that's a good amount of coverage, 71. So you're collecting $1.63. Analyze. Let's see. I'm just going to be really quick with this one because I just want to show you the margin requirements. See this? $1,100. The further you go, the expand margining will forgive you more. The closer you are to the expiration, it will charge you more. That's the only thing you need to know. Okay, volatility will also impact it. So those are the 2 things you need to know about futures options. The expand margining is based off days to expiration and volatility and a couple other things. So we'll close this one out for now. We don't need this. Okay, let's stick to our cross this out. This is the trade that we're putting in. Like I said, just bear with me. That's it. This is the strangle trade. I hope I've covered everything. If you want to know, like I said, more about these strategies, what we do, and it's filled. So the strangle trade is on. Hopefully in a few days, the P&L will start coming in. Thank you very much for watching. Hit subscribe if you like my videos, my content. The whole goal to teach you how to trade short options, all the strategies. See you in the next one.